Bond redemption is referring to when we are paying the bonds back to those bondholders that have our bonds. So this could be at maturity, or let's say you have a callable bond. This doesn't have to actually be at maturity. It could be sometime before then. So let's do the easy one first. Let's assume that we have waited all the way to maturity. So let's assume the data, again, like we talked about with our first bond example, let's assume we had 10-year, 5%, $1,000 bonds. Okay, so the face on these equaled $10,000. Alright? So it really doesn't matter what I issued them at, because if I issued them at a premium or if I issued them at a discount, both of those have already been taken care of. We've amortized them over the life of the bonds, and now the carrying value is the same amount as the face. Remember, carrying value equals face plus a premium or minus the discount. Well, if we've held them to maturity, oh, that got sloppy, sorry. Let's try that again. If we've held them to maturity, a little better, there is no premium or discount left. We've amortized all of it away. So when we get ready to redeem the bonds, the carrying value is the face amount. So for these specific bonds, we would redeem them for the face amount of $10,000. So when we need to pay those bondholders, and now we're not going to owe them any money anymore. So we would debit or decrease that bonds payable account for $10,000, and we would credit cash. Now we have redeemed the bonds. We paid them back, and now we no longer owe them. Simple as that. Now, it's not quite so simple if you haven't held these to maturity. So if you do this prior to maturity, then the carrying value is much more important. Also, something to make very certain of when you're redeeming bonds, kind of like when you sell fixed assets. When we sold fixed assets, you had to make sure you were fully depreciated, or you were caught up. All the depreciation was current before you made an entry about disposal or selling of an asset, fixed asset. You need to do the same thing with bonds. You need to make sure that before you look at your entry for your bond redemption, that you have amortized up to date either the discount or the premium if you have one. So you want to make sure those are amortized to the current date. So let's again use this information, and we're going to look at, let's say that it's been, let's draw a line here, it's been 3 years, 3 full years since we issued the bonds. Now these are 10-year bonds, so obviously we have not held them to maturity. Let's say they were callable, and we are calling them in. We're going to call in the bond redemption. And let's say that we redeem them at 98. Now again, remember, this is a percentage of face. So it's 98% of the face value is what we're going to redeem or pay them back at. Okay? So let's assume two different things. Let's first assume that it was a situation where we had a premium. And again, we'll assume the same data. I'm not going to walk you back through it. If you didn't watch that other video about the bonds, then watch that one first. But let's assume that was the situation where we had the premium. Look back and remember, how much did we amortize each year for the premium? The premium started out at, see, now I've even forgot my data. I think it was $200, and so we amortized $20 a year. Well, it's been 3 years. So we have amortized off $60 of that $200. So right now the premium equals $140. So what does the carrying value equal under those circumstances? Remember, carrying value equals the face plus a premium or minus a discount. Well, we had a premium. The face is $10,000. We have a premium still left of $140. So the carrying value equals $10,140. All right? And we're saying we're going to redeem these at 98. The 98 refers to the amount of cash we're going to pay the bondholders. And again, it is the percentage of the face, not the carrying value, but the face. So I know that the cash I'm going to pay back is going to be, for these, 98% of $10,000, or $9,800. That's how much we're going to pay back. Alright, so let's start making up a journal entry for this redemption. Well, one thing we know is I'm not going to owe the bonds anymore. So we need to get rid of that bonds payable account. That's a credit balance. We need to debit it. And the face value is what's recorded in there. So that's what needs to come out of there, the $10,000. Because we're redeeming the entire bond issue, all of those 10 bonds. Now, this also had a premium account tied with it. That premium of $140 balance, excuse me, yawn, is a credit balance. So I need to take it off the books because we're redeeming these bonds. So that premium account, premium on bonds payable, I don't really have enough room for that, so I'm just going to put premium. We need to debit it for $140 to get it off the books. Okay, so there's the carrying value, the $10,140. Now we just said that we're going to pay them cash of $9,800 because we're redeeming them at 98. 98 is the percentage of the face. Now I don't balance. I've got $10,140 on one side. I've got $9,800 on the other side. I need a credit of $340 to make this journal entry balance. Why? Well, we had a carrying value of $10,140. So on paper it looks like that's the value of the bonds. And on paper it is the value of the bonds, the carrying value. But I'm only giving $9,800 in money. So on paper, that's a good thing for me. So we call that a gain. And since this is a bond redemption, I'm going to call it gain on bond redemption. There we go. Now, let's assume the same facts, but let's assume that instead of the premium, it was the second example that we ran through. So, I'll tell you what, let's just start a new page here. So let's assume we're still going to redeem them at the 98, so that's not changing. The cash is the same. We're still going to pay $9,800. But let's assume that we were in the second example we gave before where we had a discount. Alright, so before, what happened is we had a discount of $400 originally, and we were amortizing $40 a year off of that. Well, it's been 3 full years, so we've amortized $120. I think it was $40. Yeah. $120 off in total. So the discount account right now equals, it started with 400, we've taken 120 out of that. The discount account equals 280. So right now the carrying value, again, it's face plus a premium or face minus a discount. So the carrying value is $97.20. 10,000 minus the 280. Now originally, remember when we did this, just to kind of hopefully bring a point home, the carrying value originally was $9,600. We had a discount of $400, face value $10,000. Over time, we've amortized some of that, so you see that the carrying value is increasing. It's going back up to the $10,000. The premium would be going down to the $10,000. The whole point is to get back to $10,000 as a carrying value by the time they are mature at the end of that term. For us, that'd be 10 years. So the carrying value is $97.20. We're going to pay $9,800. You can already tell that's not sounding like a good situation, but let's start out our journal entry here. So we still need to look at bonds payable. We're not going to owe these bonds anymore, so we need to get rid of them. So we debit that account for $10,000. Get it off the records. Now, we also have a discount, and that has an opposite balance. Okay, so it has a debit balance, so we need to credit it to get rid of it. So let me just leave a little space, just in case. Discount on bonds payable. And that had the balance of $280. So we're going to credit for $280. And we know we're going to pay cash of $9,800. We already talked about that. Well, we don't balance here. I need an $80 debit to balance this out. And again, we're paying $9,800 for something that has a carrying value of $97.20. So this is what we call a loss on bond redemption. Squeeze it in. There we go. So those are the two things that can happen on bond redemption. Again, when you're not at maturity, because you still have that premium or that discount to deal with.